What if everything you've been told about the dollar's stability is a lie? What if the money in your bank account, the prices you pay at the grocery store, and the safety of your savings are all illusions, engineered by a system that profits when you fail to notice? Imagine waking up one morning and realizing that your paycheck buys half as much as yesterday, your mortgage, your retirement fund, your children's tuition gone, not overnight, but with the precision of a surgeon's scalpel. Sound extreme? Sound familiar? That's exactly the kind of scenario the elite have been orchestrating for decades. And the key is a web you never see. The global derivatives market, $1.20, quadrillion in contracts. Numbers so large they don't even fit on a spreadsheet. Numbers controlled by institutions so secretive that even governments are only partially aware. Where are you watching from? Whatever city, country, or time zone, the truth is the same. This affects you. And if you want the unfiltered truth about money, finance, and power, hit that subscribe button now. Today, we pull back the curtain on a system designed to manipulate, deceive, and profit from your trust. By the end of this video, you'll see the dollar not as a symbol of freedom, but as a fragile artifact propped up by debt, derivatives, and blind belief. Historical setup and modern parallel. The story begins in 1913, when the Federal Reserve quietly emerged as the central bank of the United States. Designed to stabilize the banking system after repeated panics, it became the first step in an invisible framework controlling the nation's money supply. On the surface, the dollar appeared rock solid, backed by gold and US credibility. But underneath, shadowy mechanisms were already taking root. Private banks were not just intermediaries, they were architects of risk, issuing loans, securities, and derivatives that could ripple across continents. Sound familiar? Fast forward to 1971. President Nixon ended the gold standard, freeing the dollar from tangible backing. The world transitioned to fiat currency, money backed only by trust. But this trust was fragile, and yet it created unprecedented leverage. Financial elites realized they could create enormous wealth from nothing, using paper promises as weapons. Interest rates, bond markets, and later, derivatives, became the tools of silent power. Sound familiar? That same trust fuels every paycheck you receive and every credit card swipe today. By the 1980s, the derivatives market exploded. Credit default swaps, interest rate swaps, currency forwards, they were invented to hedge risk. But what started as risk management became risk manufacture. A handful of institutions began controlling the global supply of financial bets on currencies, bonds, and commodities. By the early 2000s, this network had metastasized into the $1.20 quadrillion shadow network, controlling money worldwide. Sound familiar? You've seen the headlines. The 2008 mortgage crisis. The narrative is simple. Greedy banks made bad loans. Risky borrowers defaulted, the economy suffered, but the truth is far darker. Behind the crisis were invisible threads of derivatives connecting banks, hedge funds, and governments across the globe. Losses were not accidental, they were engineered. When Lehman Brothers collapsed, trillions were transferred silently through these instruments. Ordinary citizens felt only the consequences: unemployment, foreclosures, devalued savings. Modern parallels are impossible to ignore. Today, inflation spikes, housing bubbles, stock market swings, and crypto crashes all tie back to the same invisible forces. The system that nearly broke in 2008 never healed. It only became faster, more leveraged, and more secretive. Sound familiar? That's because the same players, the same instruments, and the same strategies persist, and now they target the dollar itself. Midscript, twist, and cliffhanger. Here's where the story turns. The dollar's strength isn't anchored in economic fundamentals, reserves, or even US global dominance. The truth is far more sinister. The mechanism keeping the dollar alive is a complex lattice of derivatives, contracts, and shadow. Banking agreements hidden from public view and almost impossible to regulate. Every day, trillions of dollars circulate, not as physical bills or visible transactions, but as digital promises. Credit default swaps betting on the solvency of nations. Currency forwards betting on future interest rates, and interest rate swaps determining the cost of borrowing for corporations and governments alike. It's a system designed not to create stability, but to manufacture perception. And the people controlling this system, they're invisible. They sit in the penthouses of Wall Street, in the back rooms of central banks, in secret consortiums across London, Zurich, and Singapore. They don't just move money, they move belief. A whisper of doubt, a carefully timed announcement, a nudge in the derivatives market, and billions vanish or shift, unseen. It's here we uncover the heart of the dollar's engineered survival, a select network of shadow banks, creating artificial demand and pumping liquidity into the system just enough to keep the illusion alive. Without it, the dollar's collapse isn't gradual, it's instantaneous. And what triggered this invisible manipulation in the first place? Who signed off on the contracts, the swaps, and the hidden agreements that have held the world's most powerful currency together for decades? You won't believe the name. The receipt is wilder than you think, because the very people responsible for creating and selling this illusion also control the secret exit strategies for when the dollar finally dies, and they've been quietly preparing for it for decades. The derivatives market is the backbone of this hidden power. At its core, a derivative is a contract whose value is tied to an underlying asset, bonds, currencies, commodities, or even other derivatives. Multiply that by leverage ratios of 100 to 1 or more, and suddenly a tiny shift in interest rates or default risk can trigger astronomical gains or catastrophic losses. Consider credit default swaps, CDS. They're essentially insurance policies against debt defaults. But unlike real insurance, you can buy them on bonds you don't own. In 2008, AIG sold over $400 billion in CDS contracts, effectively betting against America's own financial stability. When mortgage defaults spiked, AIG required a bailout of $182 billion to prevent systemic collapse. This wasn't accidental, it was engineered. CDS contracts allowed institutions to manipulate risk perception, forcing governments to intervene while transferring wealth to the few controlling these instruments. Sound familiar? Today, similar mechanisms govern the dollar. Foreign governments, hedge funds, and central banks are entangled in a network of interest rate swaps and currency forwards. Imagine a scenario where a $500 billion tranche of derivatives is unwound overnight. Dollar liquidity evaporates. Treasury yields spike. Dollar-denominated assets collapse. Ordinary Americans experience hyperinflation-like pressure without any visible cause. Next, the shadow banking system. These are banks that operate outside standard regulatory oversight: money market funds, investment banks, and private liquidity pools. They're not insured by the FDIC, yet they control trillions in capital. At its peak in 2007, the shadow banking system managed over $30 trillion, rivaling traditional banking. Because they operate invisibly, they can leverage, collapse, and redistribute wealth at will. When Lehman Brothers fell, $600 billion of shadow liquidity vanished overnight, triggering global panic. Sound familiar? That same pattern is quietly replaying today, magnified by digital finance and high-frequency trading. Exchanges are no longer bound by geography. Algorithms can shift billions in milliseconds, creating the illusion of stability while real exposure accumulates. Let's put numbers on the table. $1.20 quadrillion, approximate value of global derivatives market in 2023. $182 billion, AIG bailout for CDS exposure in 2008. $600 billion, immediate liquidity loss from Lehman collapse. 100 to 1 typical leverage ratios used in derivatives trading. 1971, year Nixon ended the gold standard, freeing the dollar from tangible backing. Now, imagine these numbers, acting not in isolation, but as a web. Trillions of dollars circulating in invisible loops, betting on other bets, insulating the elite, while ordinary wealth erodes. Every intervention, every Fed move, every Treasury action doesn't create stability, extends the illusion, while the countdown to collapse accelerates. Wealth is siphoned in subtle ways. Low interest rates transfer value from savers to borrowers. Key programs inflate asset prices disproportionately, enriching those with early access to liquidity. Moral hazard rules the system. Greed is not punished, it is institutionalized. Ordinary citizens are left holding debt-laden portfolios, while derivatives amplify risk behind closed doors. Even the dollar's global reserve status is an illusion. Foreign governments hold over $8 trillion in US Treasury bonds, believing in safety. But these bonds are entangled in derivatives networks. The moment confidence wavers, the exit strategies of the shadow elite are executed automatically. draining dollar liquidity while leaving foreign reserves exposed. Sound familiar? In short, the dollar survives on a combination of faith, derivatives, and hidden liquidity injections. But faith is fragile, and derivatives amplify every weakness. The system is a perfect storm waiting to strike. The collapse is not hypothetical, it is inevitable. The stakes are higher today than ever before. The shadow banking network is faster, globalized, and algorithmically enhanced. The collapse of the dollar will no longer be confined to the United States, will ripple instantaneously across the globe. Your savings, retirement funds, and even wages could be halved or wiped out in days. And here's the moral. Every system built on borrowed trust and opaque financial engineering is inherently fragile. Denial is the real enemy. Trusting institutions because they appear powerful is no protection. The dollar's survival is a carefully orchestrated illusion, maintained by invisible hands with motives that do not include your well-being. We've uncovered the hidden mechanism, the global derivatives web, and the shadow banking network that propped up the dollar for decades. Now, the question is, will we wait for the collapse to feel the consequences, or will we start asking the hard questions now? Share this video if you feel the need to warn others. Subscribe for the unfiltered truth about money, power, and the real forces shaping our lives. Question the narrative, question the headlines, and never accept the official story at face value. Because when the dollar dies, it won't just be an economic event. It will be a reckoning, and you must decide, are we wiser now, or walking the same path in better suits?